In order to run a really big business, you have to know your numbers. And so today, I'm going to tell you the 6 metrics I would be looking at if I was running and scaling a business. Hi, my name is Morgan Whalen. I'm a fractional CFO, and I work with tons of small businesses every single day to help them learn their numbers, make better decisions, and increase their impact and income. So today, we're going to look at these 6. Let me know which one you find most helpful. So number 1 that we're going to look at is conversion rate. So if you think about a business, you really have sales and marketing over here, and then you have fulfillment over here. This is what I call the core of your business. And your conversion rate is really looking at the front end, so your sales and marketing efforts. So let's take, for example, you run an online business and it's based off the amount of visitors that go to your website. And so if you had 10,000 visitors that go to your website, and then on average, 100 people end up buying from you, you have a 1% conversion rate. And so you would use your conversion rate with whatever marketing or acquisition channel that you have to help predict your revenue. And this is important because it'll allow you to then see, okay, if I know this much money is coming in, this is how much I can spend in these different departments or different areas of my business to fund my operations. If you have no idea and you're flying blind about how much money you're expecting to come in, it's going to be really hard to know if you can give a raise or if you can invest to a different growth opportunity. So knowing your conversion rate, I would say, is the number 1 metric that you need to know. The second one is really a unit economic number, and that's your LTV, or your lifetime value, divided by CAC, which is cost to acquire a customer. So I'm going to break both these down and then put them together to show you why this is a powerful metric. LTV is lifetime value of a customer. So whenever you start working with a client, they're going to stick with you a certain amount of time. Whatever that time frame is, let's call it 1 year, they're going to spend money with you, whether that be once on an annual basis or maybe month to month. And over that time, whatever those costs are is going to be the lifetime value of that customer. Now, here's the thing. You want to subtract your cost of fulfillment, or the cost that it's going to take for you to provide the good or the service to that client or customer. So then that way you know what your lifetime values is at the gross profit level. Lifetime, we'll just say, is 12 months for this example. And gross profit just means, again, how much it costs for you to provide the good or the service. So let's take, for example, this pen. If this was $7 from the manufacturer in cost, and then let's say it's $3 to ship, and I'm selling it online on Amazon for $20, well, then I'm going to get $10 in gross profit for every one of these that I sell. And for a service-based business, it's about how much it costs you to hire someone on your team versus who they can help as far as clients. So let's say you hire one person that costs you $4,000 and they could service 10 customers that each pay $1,000 a month. Well, that difference there is $6,000 in gross profits. So that's an example from both the product or the service side and how to figure out your lifetime gross profits. So between lifetime and gross profits, you're going to have a certain amount. And let's say, for an example, we have $1,000 that we get in gross profits. The second part of this equation is CAC. And the cost to acquire a customer is really looking at, again, the top of the funnel here, the sales and marketing piece of how much does it cost me in my sales and marketing efforts in totality to acquire a new customer. So this is any software cost, any agency costs, any team members that you have specifically in that department, all costs associated with sales and marketing to generate new customers, new clients, new revenue into your business. So let's just say you spend $10,000 a month on your sales and marketing efforts, and you're able to get 10 clients, meaning your CAC, or your cost to acquire a customer for that month, is $1,000. Well, if it costs you $1,000 to acquire a customer and you know the lifetime that they're with you for over 12 months, they're going to give you $1,000 in gross profits. That's not good because it's a 1-to-1, meaning it's costing you just as much to acquire them as they are producing in gross profits. You net out to zero. You're not profitable. So what you want to look for is ways to get this number higher. So think 10-to-1, 20-to-1. Those are the numbers that you want, and before you start scaling your business. So you want to try to get it here to 10-to-1. So this would look like if it cost $1,000, you're able to get $10,000 in gross profits over the lifetime of that customer over the 12-month cycle. So that's the second thing. And once you nail down these unit economics for your business, that's when you then want to scale the business. You don't want to do it before you get this ratio down of LTV to CAC. And so then that takes us to the number 3, which is ROIC, or return on invested capital. And this is the one that you're reinvesting money to scale operations, meaning you have your LTV to CAC down and now you're ready to just multiply from there. And so this number is usually dollars in, right? You invest dollars and you want to get after-tax profits back. And let's say you invest $10,000. After-tax profits, you're going to want to see a substantial amount, at least break even, right? However long it takes you to get that $10,000 back is called, and this is number 4, your payback period. So if you're going to invest $10,000, the first thing you got to ask yourself is, how long will it take me to get that money back? A general rule of thumb is you want to try to get your money back within 6 months to a year. And obviously, the quicker you can get that money back, the better. And so you're always going to want to look for, how much am I investing into this project, into this initiative, into this department, and then what is my expected after-tax profits I'm going to get from that? The higher that number is, the more likely it is that you're going to want to do that thing. And if you're presented with 4 opportunities, you want to have the one that's going to get you the highest ROIC, ideally. Okay, so then after ROIC, we really touched on number 4, which is the payback period. So the 5th one that we're going to get into is revenue per employee. And revenue per employee is really a metric to measure efficiency. So think about it. The biggest expense in your business is going to be labor cost. And so over time, ideally what you want to see is the dollars of revenue that you're able to generate per dollar of revenue increases over time. If it stays flat or goes down, you got an issue. So this is one of those that you always want to keep an eye on. And the 2.0 version of revenue per employee is looking at it at a department level. So think sales and marketing divided by revenue, or think your supporting or admin team divided by revenue. And as you continue to grow, you need to use those as benchmarks to see, okay, how can we get this number even lower as a % of revenue, or whatever number that you want to use to compare against. It could be revenue, it could be another number. But the point being is, as you scale your company, you don't want any of these to become less efficient over time. You want them to become more efficient over time. And so because labor is your biggest expense, this is why I would track this, or always have this on whatever board you're looking at on a weekly, monthly, quarterly, yearly basis. And so the 6th one is your debt ratio. So to run your business is going to be from one of 2 ways, either through liabilities or equity. And so liabilities, think of credit cards, think of lines of credit, think of loans from the bank or SBA loans for long-term, but they're essentially, you're borrowing money that you have to pay back plus interest to then support your operations or to grow your business. So I would recommend keeping your liabilities as low as possible, and only use it if you know you have a guarantee. I'm not saying all debt is bad, but let's say, for example, you know you can borrow $100,000 and you have almost a guarantee that you, through your business operations, make $300,000, then I would take that every single time. So there are instances where debt is okay, but for most times, business owners start taking out debt because they can't even run their operations profitably. And if you're taking out debt to just run your operations or to fulfill your payroll, then you got a problem. You got a lot of holes that you need to patch in your business, a lot of inefficiencies you need to look at. The ideal side that you want to be pulling money from and having a lot of is equity. So equity means you're reinvesting your profits back into your business, or you're using shareholders' money or investment to then reallocate into the business. So ideally, you're looking at this, and this is a pie chart. You want your liabilities to be the smaller end of this and your equities to be the larger end. And over time, unless you have a really good guarantee way of printing cash, you want to reduce your liabilities as much as possible, because the less you have in liabilities, the less risk you have on the table. And as a small business, you're going to have a lot of risk naturally and inherently because of how volatile your market is and how your company hasn't reached a stable growth rate yet, typically. There's the 6. I'll give you a bonus 7th. And the 7th one that I would recommend and I would look at is your net cash flow. And so your net cash flow you could find on your statement of cash flows. And this is going to tell you at the end of the period, month, quarter, year, whatever you're looking at, how much you're actually converting into cash at the end of the day. So you have revenue or money coming in, and then you have your profits, and then you have the investments that you can do. You have all these financing options available to you. But what really happens? Are you positive or negative with cash? Because at the end of the day, you're not going to be able to reinvest. You're not going to be able to grow your company unless you have the cash. And so looking at this number and understanding how can we get it from negative to positive or from positive to even more is going to be really, really important. And I would always look at this as kind of a North Star to see, are the decisions we're making in our company increasing our net cash flow or decreasing our net cash flow? So let me know which metric you're going to be looking at more often now, or one that you didn't know you need to look at and you need to start looking at. Leave it down below the comment section, and I'll catch you on the next one.